Welcome to today's Explainer. We're jumping straight into the massive tax incentives available to North American businesses in 2026. And, well, we're going to organize them into an actual, actionable playbook. If you're a business owner, a financial officer, or maybe a medical practice manager, how you choose to write off your equipment purchases this year is honestly one of the highest leverage tax decisions you're going to make. We'll be looking closely at Section 179, the newly restored bonus depreciation rules, and how your financing structures can literally make or break these deductions. Let's kick things off with a totally staggering number, $2,560,000. I mean, wow, that is the maximum Section 179 deduction limit for the 2026 tax year. Thanks to recent inflation adjustments and legislative changes, this represents the highest deduction level we have ever seen. It's a hyper-targeted provision in the tax code, specifically designed to encourage businesses to invest in themselves by offering a massive upfront tax break. Here's the real game changer. Instead of tying up your hard-earned capital by slowly, painfully depreciating your equipment over 5, 7, or even 15 years, Section 179 completely flips the script. It allows you to expense the entire cost in year one, keeping your cash flow healthy and available for immediate operations. To make sure we don't get lost in all the tax jargon, we're going to follow a clear 6-step roadmap today. We'll cover the 2026 equipment opportunity, unpacking Section 179, 100% bonus depreciation returns, Section 179 versus bonus, leasing, buying, and tax, and finally the placed in service rule. All right, Section 1, the 2026 equipment opportunity. So what actually qualifies? Honestly, the sheer variety of property is pretty remarkable. We're talking about everything from heavy machinery and off-the-shelf business software to heavy SUVs, the ones between 6,000 and 14,000 pounds, which actually have a specific deduction cap of $32,000 this year. It even includes non-residential improvements like HVAC systems, roofs, and alarms. Oh, and for our Canadian viewers, Class 53 offers a temporary accelerated capital cost allowance, meaning a 75% write-off for qualifying manufacturing equipment right in that first year. And remember, both new and used equipment qualifies as long as it's new to you. Moving right along to Section 2, unpacking Section 179. Okay, you need to lock your eyes on this next figure, $4,090,000. Why? Because this is your 2026 spending cap or phase-out threshold. See, Section 179 is really built for small to mid-sized businesses. So the moment your total equipment purchases for the year cross that $4 million mark, your maximum deduction starts shrinking, dollar for dollar. And once you hit $6,650,000 in total purchases, the whole shebang is completely phased out. But here's the brilliant built-in safety net. Section 179 is strictly limited to your business's taxable income. Let's say your business shows $80,000 of taxable income before the deduction. The absolute most you can take in Section 179 is $80,000, even if you bought, say, $400,000 worth of equipment. Basically, you can't accidentally deduct your way into a tax loss. Any unused portion just carries forward to the next year until you have the profit to absorb. Let's dive into Section 3, 100% bonus depreciation returns. Now this is where things get really exciting. Under the recent One Big Beautiful Bill Act, or OBBBA for short, the step-down phase-out for bonus depreciation, which had dropped to 40% in 2025, was completely canceled. This allows businesses to once again automatically write off 100% of a qualifying asset's cost in year one, with absolutely no annual cap. This applies to property placed in service after January 19, 2025. And unlike Section 179, bonus depreciation applies to entire asset classes automatically. And crucially, it actually can be used to create a net operating loss. Just to put this into perspective, let's look at IRS Revenue Procedure 2026-15 and how this bonus interacts with passenger automobiles. Because of the restored bonus depreciation, the statute gives a specific bump, pushing that vital first-year depreciation limit to over $20,000, specifically $20,300. If you're a tax professional advising clients on fleet or business vehicle acquisitions this year, this is an absolutely crucial piece of the puzzle. Which brings us to a fork in the road. Section 4, Section 179 versus bonus. So how do you choose? Well, when we compare them side by side, the strategic vibe is totally different. Section 179 is like a scalpel. It's capped, it's an asset-by-asset opt-in, and it's limited by your taxable income. It's great for surgical tax planning. Bonus depreciation, that's more like a sledgehammer. It has an unlimited annual cap, It's automatic for entire asset classes, and yes, it can deliberately generate a net operating loss to carry forward. Also, a quick aside, keep state conformity in mind, because many states decouple from federal bonus depreciation, which can make Section 179 the cleaner choice for state taxes. Actually, the most brilliant strategy isn't choosing one over the other. It's stacking them. It's like a giant puzzle for your tax return. Step 1. Elect Section 179 on your highest priority assets first. Step 2. Hit the remaining eligible equipment base with 100% bonus depreciation. And Step 3. Just let standard make-RAS depreciation handle anything left over. Boom! This layered approach maximizes your federal deduction while keeping state tax headaches to a minimum.
All right, moving to Section 5, leasing, buying, and tax.
Okay, listen closely to this part because how you pay for the equipment literally dictates your entire tax outcome. If you go with a $1 buyout lease, also known as a finance lease, the IRS treats you as the owner from day one. You get the full Section 179 deduction up front. But if you sign a fair market value, or FMV lease, the IRS treats it as a true lease, meaning no Section 179 deduction for you. You only get to deduct your monthly lease payments. If a vendor offers you a slightly lower monthly rate on an FMV lease, please run the tax numbers first or you might forfeit a massive upfront deduction. Let's ground this in reality with a quick example. Imagine a clinical laboratory financing a $250,000 lab system. If they use a $1 buyout lease, they can deduct the entire $250,000 under Section 179. Assuming a 30% effective tax rate, that instantly yields $75,000 in year one tax savings. It's wild, right? Your effective cost drops all the way down to $175,000. You get to preserve your working capital with manageable monthly payments, but you still capture those huge tax savings upfront.
And finally, the ticking clock. Section 6, the placed in service rule.
This is absolutely crucial. Merely signing a contract or writing a check for equipment doesn't cut it. To get the deduction, the asset must be placed in service. That means it's fully delivered, installed, permitted, and completely capable of performing its intended function before midnight on December 31st. A shiny new $200,000 machine sitting in a wooden crate on your loading dock while you sip champagne on New Year's Eve? Yeah, no way. That does not qualify for a 2026 deduction. And this is exactly why Mitchell Rubin, the CFO over at Medisca, hit the nail on the head. He pointed out that if you're buying complex equipment, stuff that requires site prep or vendor calibration, you have to account for supply chain delays and installation lead times. Waiting until late December is just a massive risk. You should literally be planning those end-of-year purchases as early as November to ensure everything is up and running in time. Which brings us to our final question. Now that you have the ultimate playbook and knowing the massive tax incentives available in 2026, with record high limits and 100% bonus depreciation, what is your next move? How will you strategically finance your equipment to fund your own growth before the clock strikes midnight on December 31st? Are you gonna let your hard-earned capital just go to taxes? Or will you use it to invest in the future of your business? The clock is ticking, so start planning your strategy today.